What's up, everyone? Today I'm going to be showing you my top 5 index funds and then also what to look for in an index fund before investing. So let's begin. Important things to consider. First, fees and expenses. As investors, we want to limit the amount of fees that we incur, whether that be by management fees or taxes. I like to look at the expense ratio, which usually will tell you how much the managers of the fund are going to be charging you per year. It's usually in a percentage. Try to keep that as low as possible. Second, the turnover rate, or essentially how often the fund turns over its assets. This is a measure of, more actively managed funds are going to have higher turnover rates, which means that they're buying and selling securities in a shorter amount of time than in a passively managed funds, which usually invests in, more long-term, safer, quotation marks, safer at this time in economic climate, but more of like a long-term investor in mind. The one thing to note about turnover rate is the higher the turnover rate, the higher the taxes that you're going to have to pay, because due to the fund, buying and selling securities in a shorter amount of time, they're going to incur a higher tax bill because, securities that are bought and sold over a 1 year or under a 1 year period are taxed a capital gains rate of like around 30%. And then if you hold it for longer than a year, it's much lower at around 15. So keep that in mind. Next, I like to look at ratings, so like Morningstar, Lipper, um, and just kind of see what professional research analysts have to say. Do your own research, but use it as a benchmark. But also the other thing is don't take Morningstar and Lipper's words as the golden rule. Do your own research, learn how to look at funds, trial and error. And yeah, you'll be able to identify good funds, but you definitely just take a look at it. Next, I like to look at historical performance of the fund. So, whether there's going to be a linear growth model that's attached to each fund, see how they perform in downturns. So specifically, I like to look at, the '08 recession, dot-com bubble, even during COVID, just see the extent to which they drop when the market drops, and that has a correlation to the beta or how, closely it goes along with the S&P or, the respective market that it's in. So yeah, be sure to look at historical performance. You don't want to have a fund that's, very even, that doesn't grow, definitely one that's linear. And you're going to find a lot of those in an S&P 500 index fund. Next, look at the diversification within the fund, specifically what are the individual holdings that exist within the fund. You want to be sure that it's well represented by industry, sector, and then within those industry and sectors, make sure there are multiple companies in there. One of the Vanguard funds I'm going to be showing you guys later has 8,600 holdings, and that's just like mitigating risk and just ensure that you don't put all your eggs into one basket. So first, there's the Fidelity 500 Index Fund. This makes up a bulk of my Roth IRA right now. It tracks the S&P 500. Its net expense ratio is 0.02. Management fee is 0.015. So your total fees are going to be 0.035% or $3.50 for every $10,000 invested. This is, extremely low for any kind of fund. You look at the historical performance and it's very linear, but you see how much it dropped during COVID. That's something to just keep in consideration. Granted, this fund was, its inception was, I think, around 2011. So, you can't really see a long period of time, close to 10 years, but, it tracks the S&P 500. So it's pretty much just going to mimic what the market does. The ratings, look at the Lipper, it's 5 for everything. That takes into consideration everything from tax efficiency to historical performance to preservation of your capital. This is going to be something that, should be a good backbone in any portfolio. Similarly, there's the Schwab SP 500 Index Fund. The expense ratio is slightly lower at 0.02%. Like the Fidelity Fund, it tracks the S&P 500. And, this fund has been, its inception was 97. So it's obviously been around for much longer. Whoops, going back, it's returned 275.43% since its inception. At the one thing that you guys need to realize is that index funds, you're not, trying to get rich quick. This is like a guaranteed way to preserve and grow your money over time. So you're kind of like suffering the time in a way, but if you're patient, if you can delay instant gratification, you're going to be very happy in the long run. Ratings are good. I think the 4 is for tax efficiency. But yeah, moving on. So the PowerShares SP 500 high dividend, low volatility portfolio, ticker SPHD. So this is kind of different. It tracks the S&P 500 in a way, but it looks to the blue chips, dividend-paying equities, takes the 75 highest yielding constituents of the index with a maximum of 10 stocks in any one particular sector. Then it takes the 51 stocks with the lowest 12-month volatility from the group, so you're getting a high dividend yielding fund that has low volatility. This provides consistent, even returns and has even performed the SPY, which is the main index fund that tracks the S&P 500. It's the most widely invested in S&P 500 index fund and other dividend ETFs in the past. So the Lipper score, it's important to look. It looks kind of shitty, but the one thing to take into consideration is I think this is a very recent rating, relatively recent in terms to COVID-19 pandemic. So obviously you look at its returns and it's just been dreadful, but it's quite linear if you look at it, although, always do your research, see what other people have to say. The other cool thing about this and importance to incorporate into your portfolio is that it pays a 15-cent monthly dividend. I kind of consider this to be something that you invest in and kind of put to the side and just, while 15 cents to the average person doesn't look like that much at all over time, your dividend will not only, increase, but if you reinvest it back into the principal, your principal will also increase. So not only are you getting gains from, capital gains, but you're also getting that dividend increase, which, after 40 plus years, it's really going to add up in the long term. Next, we have the Vanguard Total World Stock Market Index Fund, VTWAX. So this allows exposure to non-US holdings, which is very important when diversifying a portfolio is, you think about what can I diversify? If you're only invested in stocks and not bonds, that's bad. But if you have good U.S. exposure, it's a good thing. But you can also add that foreign diversification in foreign markets, which is ultimately just going to mitigate your risk in the long term. Foreign markets, although have lagged in the last decade, there's a lot more regulation around, various kinds of finance and whatnot, foreign in comparison to the United States. So just be careful. A lot of this has to deal with emerging markets, and emerging markets are more risky. They are not all profitable by any means. However, it has 8,600 holdings, which is a way to mitigate risk, and it's just kind of like a good way to expose yourself to non-U.S. markets. So the one thing about this fund is that it has a $3,000 minimum if you purchase VTWAX through your broker. However, there is an ETF version with a ticker name VT. Has a slightly lower expense ratio of 0.08%. It also pays a quarterly dividend of 13 cents, which is nice. It's not monthly like SPHD, but still, any kind of return and a dividend payment is good. So the other thing is that this is a very, very young fund. You look, its inception is February 2019, so it's been, a year and a half. However, since then, it's gone up 16.19% since its inception. The other thing to realize is that, the well-spoken yearly average of the S&P 500 is 7%. So to compare 7% to 16.19%, obviously, this is something that I would add, and I do have in my portfolio. However, be wary. You can see how much it dropped, during COVID. So just be careful. That's all I'm going to be saying about this. There's a little bit more risk because it's foreign, but it kind of makes up for it for the number of holdings that it has. This is probably one of my favorite funds, and this is the last fund that we're going to go. So this is the Vanguard Mid Cap Index VMAX, which has a $3,000 minimum if you go through your brokerage, or it's also in an ETF as VO. This invests in mid cap stocks, which people have always said that mid cap stocks are, like the sweet spot of the market. They outperform large cap stocks, but aren't as risky as small cap stocks. That's kind of the thinking behind that. So since its inception in January of '01, it's up 335%, or an average of 17% per year, which is, incredible returns. Its expense ratio is also very low in consideration to the, returns that it's provided at 0.05%. And if you also look at, excuse me, if you look at the Lipper reading and ranking, it's fives in everything except for preservation, which, you know, in a way I kind of disagree with, because if you look at how linear the growth is, just the, percentage gains it's increased since its inception, it probably is a four for preservation just because it's mid-cap stocks that you're dealing with. If this were able to get the same amount of return with large cap stocks, it would be fives. So that being said, I hope you guys enjoyed the video. Please let me know if you guys have any questions. Yeah, thanks again for watching.